Hey, everybody, good afternoon. This is Doc and Dave of 12minutetrading.com, and today is Monday, the 14th of November. So we've had a nice rally for the last couple of weeks. We had a great CPI report last week, which surprised to the market to the upside. Best news that we've seen in the last 6 months. So I guess the question at the table now, Dave, is this rally going to stick, or is the Fed going to find some way to kill it?
Well, this will be the pivotable week, I think. In that, I said to my students this weekend in my newsletter and everything that we got plenty of run room from here. We've got run room to about the jobs number at the beginning of December at this point. Now, there's a few details that could, or some news events that could move things that coming up. We got retail this week, like Walmart reports this week, and some of that. But I don't think that's enough to really stop the trend that we're starting into. I think a lot of that stuff's already priced in as the market does and everything. And it would take some pretty egregious misses or, wrong numbers, like from the expectations, to really, I think, derail things. I just don't see any major market moving events. The two things the Fed cares about most: jobs, and that means killing jobs, because they want to stop the job market from growing. They want to see it soften. And then inflation, right? So why we jump up next week? Inflation came in lower than expected. So, quote unquote, a miss on expectations to the good side, right? And we kind of are in this weird environment where there's only one good news event that is good, and that's the CPI report. So if it comes in lower, good. Everything else, bad news is good news. So what we want to see now is we want to see the jobs report in early December come in light, right? Or negative, right? We see a lot of layoffs happening, which, I think gives a little fuel for now. I don't think the Fed's done. I think the Fed's going to do 50 basis points in December, but I think they're going to start stating that they're going to slow down. I think we're towards the end of the rate hike cycle, obviously not towards the beginning of it. And so the market senses that. And so we've got that kind of time of the year. It's the fourth quarter, getting in the holidays. These fund managers got to show some returns, right? So get this run up. I think, 4,100 on the S&P is the next big level to watch, but I think 4,300 could be the top of this thing if it really wants to go the whole distance. And then from there, it'll be right about that time. Jobs numbers, the next CPI report, and right after that's the Fed. So if this thing's going to fail, it's going to be in the beginning of December.
Cool. Just for context, I'm going to run this over to our charts here on the left-hand side. Let's see. So we're looking at right now, we're right at 4,000 on the S&P. So we've had a nice little rally, but it doesn't really compare to the one that we had from June to August yet.
Right.
So I think what Dave is saying is, like, we might be able to, if it gets up as high as this would be an equivalent amount to that. So that'd be about 4,200, but 4,300 could be the top of this. Myself, I think personally, I think it's going to have difficulty getting through 4,100 the first time through, and we may get some consolidation up in this area. Actually, we may even pull back as far as 3,900. And see, this is what I'm thinking may be the event here, because if we see this pull back to 3,900 and generate a whole bunch of short interest, this is the type of slingshot move which can get it pushed through that 4,100 level and up to some higher numbers. So from there, one of two things will happen if we pull back like that. If we pull back to 3,900 or some level, that's becomes a higher low. If this fails on a stunted little rally, like maybe up to 4,000, this is going to be your 2008 analog. This is where we're going to see, true blood in the streets, because this could be actually just as bad as what we saw. So one of the things that I did,
you stole my next point on that. The other thing that I shared with students this weekend is that right now we've broken the analog, right? So there's been some really good people. In fact, on Twitter, Mott Capital's done a really good job. If you follow different people on Twitter, they've done a really good job of the analog. And up until last week, it was following perfectly. And that breakout is now going up, where the analog for 2008 went down. So that doesn't mean we can't go up some and then return to following it, but we certainly have broken that protocol. Where we haven't is on the VIX. So if you look at the 2008 versus the 2022 on the VIX, 2008, another couple of weeks of going down on the VIX before it skyrocketed to like 60 or 70, and all the carnage really took hold. So there is that possibility that we have to be on the the lookout for. As I like to say, you got to have a healthy paranoia in trading a bear market like this. So,
Something
that's it.
I was walking my team through this morning was to watch out for positive divergence on the VIX. Now, what could that be? So this is where if we see the VIX, of course, like this, has been heading down. If we see the VIX starting to work higher like this, at the same time that the overall market is heading higher, then we're seeing divergence there. And these are usually pretty accurate. A positive divergence on the VIX is usually pretty accurate of saying that somebody knows something, right? Somebody knows something that's happening pretty soon, and they're taking advantage of it right then and there at relatively cheap volatility prices. So watch out for the positive divergence on the VIX in the near term. Otherwise, we'll look for 4,100.
We also have a lot of Fed speakers this week. Today's Monday, and really over the next few days, there's two, in some days even three speakers happening. And for the messaging, it really does seem like they want to kill this thing, right? They do not want to see the markets excited right now. Even though they're like, hey, we might be able to slow down, they're still, we will not stop until inflation is at 2%. You know what I mean? So they're still pounding the table on that. Bullard speaks on Thursday. He's probably the most hawkish of all the board members. So it'll be interesting to see what happens on Thursday when he talks. But the other thing to watch is the dollar. As these guys speak this week, one of the reasons that we had that run up last week is the dollar, which has gone parabolic. It was due for a pullback. I don't know if you can pull up a chart of the DXY there, Doc, and show it to him like a daily chart. But man, it had just gone parabolic. It needed to pull back, and it did that. It coincided with the CPI last week and started to pull back. But today, it started to level off. We had one of the speakers talking actually over the weekend, Wallen, and reiterating their commitment to things, and the dollar started to turn back around. So watch the dollar as well too. If the dollar starts to go back up again, that's going to put a damper down on the rally in the markets.
Absolutely, yeah. We've been watching that just about every time, and also a good proxy for watching the interest rates, just a 10-year note. So the 10-year note has been going up as far as 4.3%, and now is back down under 4. So again, this is more of a 6 to 9 month view of long-term rates that is well ahead of where the Fed is these days. So This is what this is the bond market saying that things are going to get perhaps a little bit soft here in the near future as we get into maybe the beginning of 23.
Yeah, so I mean, so that's kind of where things are at overall in the markets. The energy's there, Doc. If you're showing on the screen, showing the fractal energy, like the daily chart energy just started to release last week. There's plenty of that left to take this thing further. We had the move that we had down really was a weekly chart release on the energy, and that's got to recharge. And one of the best ways to recharge it is go the way it came from. So if you look at a weekly chart, literally we could go back up to 4,100, 4,200. That would just be sideways movement for the span of a couple months. Really, you went nowhere over the course of a couple months. Remember, at the end of August into early September, we were around 4,200 or so on the S&P, right? So to get back up there, that would just be sideways action for the span of a few months, right? And that would charge that weekly chart back up. And that's another thing to watch. We get to where that's charged back up again. Then, you got the setup for really either way. If the market wants to follow 2008 at that point, you've got all the energy to do it. Or unless things go to the positive side with jobs in December and then the CPI continues lower, then it could, be off to the races. The Dow, I think coming in this week was only 2 or 3% off from getting back into a bull market again.
Yeah, absolutely.
So it's possible.
So a couple of things here for folks to watch. First of all, if the price decides to go higher, which we would encourage it to do, then we're probably going to run into 4,100 in the short term. So there's only so far that this can go. So we may see this bonk its head at 4,100, and that would be around the same time that the daily chart runs out of gas. And so seeing a consolidation up there, that would be super bullish. However, more likely would be an actual pullback. Now, if we do see a pullback, 3,900 should hold. If it does not hold, that's not particularly good. Watch the trend line connecting the dots here for all these rising all these significant higher lows. Watch the trend line. That comes into play right around 3,900. So if we see a pullback in the S&P, and this is, I'm looking at the cash index here, 3,900 should hold. If it does not hold, then this is an erosion, right? We're probably seeing the transition into lower highs and lower lows. So that may be an early call if the price is not able to hold 3,900. So look for 4,100 to the upside, 3,900 to the downside to hold. And, again, if we do hold 3,900, this could end up slingshotting here. So that to me is going to be the magic level that's going to dictate everything in the short term.
And we're getting kind of that 3 p.m. Movement with the pros right now. We just had a pretty big sell-off in the last few minutes, taking us back down to kind of where those, not quite the lows of the day, but we were up above 4,000. And now what are we at? I think I see 39.82. So we've had a 25-point swing in the S&P in the last few minutes, and that's pretty common. You'll see this kind of play out till about 3:30, and then they may run it back up into the end of the day. But today's one of those days. It's actually good after the moves that we've had. You don't want to see a market just go parabolic. You don't want to see it just keep gapping up and gapping up and gapping up, because it just comes down that hard and that fast once it runs out of that energy. The best thing for this market would be, pull back a little bit today. Flat day, maybe the S&P's down 10 or 15, that sort of thing. NASDAQ's down 80 or 100. The Dow maybe down 50 to 100 too, and then grind higher from here. That would be the best thing to keep a nice trend intact. If we're not going to do it really quickly, like Doc said, go back to 3,900 and then slingshot higher. The best thing would be for things to grind. If we go parabolic on this, it's just going to crash right back down to earth.
Yeah, I totally agree with what Dave is saying, because the best thing that we can do is we can see like a small little volatility coil sitting up under 4,000, because we're getting pretty close to running out of gas here at this point. Mm-hmm. And so a little volatility coil underneath 4,000 and see the break higher from here. So if we go back to what we saw in the June to August rally, this is exactly the type of price action that we want to look for. We want to see a break. We want to see a short little coil. We want to see a break. Look at this. This is picture perfect. And then here's the next break, the next coil, and unfortunately hit its head. And then the Fed torpedoed this market at that point. So this was Jackson Hole, and everything fell apart after that. But this is the type of
that transpire over.
This is from mid-June until, this is 2 months. That's a 2-month rally.
2 months. What happened the last 3 weeks of it?
The last 3 weeks of it, of the rally?
Mm-hmm. Yep. Because that's about where we are till the next big data dump, with jobs and CPI, and then
this is where it went in. This is where it went into stair stepping mode. This is perfect stair stepping mode, which is exactly quite in trending character. So we want to be looking for that. However, we also want to be cautious of the downside potential to this.
Yeah, it has to prove it to us, right? We talk about the 4 phases of the market, really. And the 4 phases of the market are disgust, disbelief, acceptance, euphoria, right? So, gosh, just a few weeks ago, we were pretty much in disgust, right? We're at 3,600, dipping below there, even got down towards 3,400, on an intraday. And so that was pretty disgusted. Everybody was throwing their hands up and everything else. And then typically the market rallies in disbelief, which we had, right? We had a rally in disbelief. Nobody believes it, right? And it's got to prove itself. And then we came back down until last week, where we really punched higher. And it's the same thing. It's disbelief right now. Nobody believes it until it starts to hold. Then you get acceptance, and then things start to kick in, and you get back to euphoria again. And
see, a day like
where everybody's on,
day like a confirmation day, like Thursday could have been a one-day wonder that was immediately faded back down. It was not.
Yep.
And Friday ended up a little bit weak. This is what I call a Groundhog Day, where we start out weak and then we end up squeezing all that, that negativity out of the market again. So Friday was a confirmation day, and today is like just an inside day. This is just marking time. So to me, this is exactly the type of character that we want to see.
Yeah. There's another factor too. There's another factor too that's starting to happen that people need to pay attention to, and it's driving it. Everybody's like, "Gosh, these 100-point moves in the markets and these different things." I think you and I can attest. Even 5 years ago, you didn't see things like this, right? And some can chalk it up to a bear, but there's some other things that are happening out there to where, depending on the bear has something to do with it, but we're now trading options every day. The S&P, SPX, the NDX, the RUT, all of those European style ones have had everyday options for the better part of the year. But this week, it started on the SPY and the Qs and everything else. And so now you have options, basically zero DTE, every single day trading. And that's going to, affect how markets behave. And so last week, I think, some of the reason we got such a big move is we had a lot of people I'm just going to buy puts for Thursday, and do that to protect myself. And then they got squeezed out. So I think we're in a market, and we will be for the future, that's prone to these kind of volatile and sharp moves, because now we have not just a Friday options expiration, it's every single day. And that presents a lot of opportunity, but it also is going to mean a lot more movement in the markets, like we're seeing. So we're not going back to the 5 years ago, I don't think, anytime soon type markets.
The other thing to keep in mind is with the S&P at 4,000, and you and I started trading the S&P when it was less than 1,000, right? So if we had a 10-point day, that was a big deal. That's huge. 1%. Was a 10 handle day was 1%. Now it's a 40 handle day is 1% on the S&P. So if we see a 3% day, that's 120 handles. So the volatility is normalized to a percentage of what we're seeing. So yeah, this is like day traders paradise, because it's still the same margin. And we can still use, whether it's futures or options or whatever, looking for directional moves, or maybe not even directional moves, looking for a sideways move. So today is a range day, just like nowhere going on, just market time. And this is exactly
great iron condor day.
Exactly.
Zero day to entry. Today was a great iron condor day.
Everything I put on Friday is just about gone. And half the positions I put on this morning are already eroding like crazy. So.
Oh yeah,
it's a great thing.
Me too. I mean, I put on positions for the target 100s for Friday, and already looking really, really solid. Now that could change it. We might have to stay in for another day or so if we get a big move tomorrow. But I don't think so. I think we're gonna have some softness till about the middle of the week, and then we'll trend through the back half of the week. We need to get through some of these Fed speakers and a little bit of this data, and probably a Walmart earnings. Right, you're gonna have some moving around that. We could even see us go down a little bit and then run higher into the end of the week, and that would be again the best thing to keep this rally alive. So I would welcome that.
Hey, Dave, one thing that we should mention here before we wrap up today is that we're actually speaking several times this week. I'm speaking tomorrow. I feel
like a Fed speaker this week.
Yeah, I'm speaking tomorrow. You're speaking Wednesday and also on Thursday. At different places. Yeah. So what we should do is in the comments below this video, we should post those opt-in links for people that if you stumble onto this video in the next couple of days, if you want to see more from one of us, we're going to be doing some targeted presentations talking about what we do and how we trade in the market. So we encourage you to join, and we'll also check out the
community too.
Yeah. So look for the opt-in links in the comments below this video. As soon as we terminate this video, I'll get those added.
And for those of you that are attending, I know we do these, every week and stuff. And so we've got people that are starting to attend. If you have questions that you want to, ask us, feel free to do it during the, this session, but you can also send them in prior. If you got something like you want us to cover, topics you maybe want to cover for the day. Hey guys, could you guys talk about X, Y, or Z? We're happy to do that. You can send those to us at support@12minutetrading.com. Our team will get those to us, and we can, start tackling some of those topics that you may want us to sound off on and that sort of thing too. So don't be afraid to do that. We'd love to hear from you guys.
Okay, well put. All right, I think we are set for today. So we're just holding off for tomorrow's PPI, and then we'll see what kind of we'll see what kind of damage the Fed does to the market this week. But I think we have a nice momentum to the upside. We're almost in acceptance mode now at this point. So a little bit more upside and then batten down the hatches.
Thanks, everybody.
All right. Thanks, everybody. Thanks for joining us. And we'll see you next time that we chat here on 12-Minute Trading. Take care. All right. Good job.